Welcome to Market Call. I'm Morella Fernandez. Dan Wong on the show today. He's portfolio manager at Scotia Wealth Management. He'll take your questions on North American large caps and ETFs. Here's how to reach us. 1-855-326-6266 if you'd like to call in. You can also email your questions to marketcall@bnnbloomberg.ca. Stan, thanks for coming in today. Good to see you.
Great to be here. Thank you.
Let's talk about the markets in general. TSX has another record close yesterday. It's had several this year. S&P still not getting there. Why do you think that is?
Well, first of all, I mean, 2 months ago, who would have thought that 2 months later we'd be at record highs for the TSX? The S&P up 20%, Nasdaq's up about 28%. The S&P has rebounded very nicely. In fact, a little bit more than TSX since those April lows. So I think it's just a matter of the fact that the S&P has had a really great run and trying to reach those all-time highs again. We're 2% away. Just took a little bit tougher time than the TSX, which actually lagged a little bit, as you know, over the last couple of years.
Where do you think we stand as far as the disruption of trade goes? We've had China and the U.S. sort of work out a framework, not a lot of details. China kind of saying one thing, the U.S. president, of course, saying something else. Do you think we've seen most of that disruptive force already work through?
I think so. I mean, it looks as though the U.S. and China has a deal in place. It needs final approvals, of course. All eyes are on that, and we'll see what happens with that. There's obviously some other countries that we'll need to deal with. But, underneath it all, recession fears are easing, inflation numbers are cooling to a certain extent, and the labor market is very steady in the U.S. So that economic backdrop is still strong, and I think that's what's carrying the markets these days.
The economic status in the U.S. seems to be holding right now. I'm just wondering, are you looking outside of North America as a result of what happened in April, or have you sort of come back more into North America?
That's a great question, because we actually are moving a little bit out of the U.S. and out of the Toronto markets, just because we see valuation discounts outside of the North American markets, whether that be international markets or European markets. I think that a cooling or falling U.S. dollar, like an uncertain U.S. dollar, helps those markets in terms of investment as well. So, falling interest rates around the world outside of North America helps. Uncertain U.S. dollar helps, and the fact that for a while valuations have been at a discount outside of North America.
So are there certain markets you're specifically looking at?
Well, I'm more company specific, so some of those names will land, and I'm not looking for countries or regions necessarily. I'm looking for companies. So some of those names could be something like a Mercado Libre out of Latin America, and it could be some names out of Asia and so forth. So it's really more company specific rather than pinpoint a region or a country.
Got it. Okay, we're going to take a quick break and line up some phone calls and emails for Stan Wong of Scotia Wealth Management. He's taking your questions on North American large caps and ETFs. Back in a moment. Welcome back. Stan Wong with us today to take your questions. George has written in an email. He says, good day. What is the guest's opinion on Dollarama? Is this a good entry point for a long hold, or does the guest have an alternative in the sector? Dollarama reported this week and it's doing pretty well.
Yeah, had great numbers yesterday, hit an all-time high yesterday. This has been a long-standing name of mine, and I've highlighted it in top picks for Market Call and past segments. I continue to like this name. I think that Canadians are continuing to downshift their spending into more affordable channels like Dollarama. I like the fact that Dollarama has 60% of its sales from private label items, which increases margins and sort of differentiates themselves from other competitors. Not that there's a lot of competitors in Canada to Dollarama. International expansion into Dollar City in Latin America is also, long-term growth prospects for a company like Dollarama. It is a premium valuation at around 41 times forward earnings going forward. We see 15% growth rate, so still a bit of a premium, but I think you're paying up for that limited competition industry that we're seeing with where Dollarama is.
So the second half of the question, was there another in the space? You would still stick with Dollarama?
Our name is Dollarama. The portfolio, we continue to like it. We continue to hold it. If we were to look to add money, new clients, we'd probably wait for a better pricing opportunity than where it is today.
Got it. Okay. Let's go to the phone lines. Jim is on the line today from Elliott Lake with his question. Hi, Jim.
Good afternoon. Stan, CNQ, wondering if you can talk about it a little bit, maybe the Canadian energy sector as well, but would this be a good entry point for CNQ?
Okay, let's pull up the CNQ chart and have a look at that. What's your take on energy? Oil's obviously coming back, but we haven't heard much more from Washington on sort of energy as much as we heard sort of a few months ago when they were really touting oil and everything else.
Yeah, and if you look back in history, I mean, talking about drilling and so forth, has not necessarily happened in terms of helping the energy names. It happened back in the last time that we talked about that in the last term. Oil's been under pressure, energy stocks have been under pressure, oil prices have been coming down just simply because there's concerns about the global economy. Canadian Natural Resources, Suncor, all these types of names are in a bit of a downswing. The nice thing about these names is you're getting a pretty good dividend. You're getting an over 5% dividend yield from Canadian Natural Resources. I see the chart here. The 200-day is falling. The price is below that, although it's just reached that right now. So it's at a bit of maybe an important inflection point to see if it breaks above this 200-day moving average, which would be a positive technical indicator. Obviously, we're seeing some potential geopolitical rumblings around the world, which could push oil prices up, but that's really just speculation. We don't know if that will happen for certain. Right now, I would say that the sentiment around the energy sector is rather weak. I think that the energy sector on a valuation basis compared to the last 10 years, compared to the indices, is very cheap, but it doesn't mean that we want to jump in there right now. I think we need to see a little bit more evidence of an upswing, a little bit more evidence that the global economy, or at least the market needs to understand that the global economy is not falling into a recession. It's going to start moving higher. Then I think we see some of these oil names moving higher. And of course, OPEC has not really been cooperative. They're increasing production as well.
Okay. Jim, I hope that helps you out as we move on to John from London, Ontario with a question. Hi, John.
Hi, Marilla. Hello, Stan. Oracle was a stock with many elements to it. It had a big rise before the bubble crash in 2000, had a precipitous fall. I picked up a quarter of position last year, and now their latest quarter, they're announcing that 2026 earnings will be up 70%, revenue up 70%. Have you had a chance to look at the details, Stan? You probably have. Let me know what you think about increasing my position. Thank you.
Okay, so the 70% does sound sort of astronomical, a little bit unbelievable. I don't know if you've had a chance to drill down on the details, but...
It's not a name in our portfolio, and I haven't really had a chance to really look very closely. I saw some of the headlines and so forth. Obviously, the stock has hit a 52-week high, if not an all-time high today. So the name looks interesting, given the space that it's in the cloud space and so forth. Valuation-wise, it's actually not an expensive name. We see valuations at 2 times PEG ratio right now, with a forward PE of around 29, 30 times, and you're getting about a 16% earnings growth rate going forward. So it's actually, not too bad at 2 times PEG. As you know, in the tech space, you're seeing 3, 4, 7-time PEG ratios out there. So not a bad name. It's not a name in our portfolio. I like some of the other spaces in the tech space. But from a technical perspective, it's meeting the criteria in terms of what we're looking for, in the fact that the 200-day moving average is trending higher. It's above that 200-day as well. But as you know, this stock is a very high beta, volatile stock as well.
Got it. Okay. Let's move on to another caller, Sam from Toronto, with this question. Hi, Sam.
Hi. I'd like to want your opinion about HHL, Harvest Healthcare Leader. I know it is a covered call and U.S. security, but I bought it in my RRSP, so I don't have to pay any taxes. I just like to know what is your opinion in general for the healthcare industry, because there is a lot of noises going on in the States about reducing the drug prices and everything. I appreciate your opinions. Thank you.
Thanks for the question. So healthcare has been the stocks that have not sort of bounced back, it seems, during this time. What's your forward take on whether or not they will? Do you own any healthcare? We
do, but in a very specific space. We'll talk one in the top pick segment. I would suggest that the healthcare space alongside energy is fairly undervalued relative to history. I think a lot of this because we've got very different types of industries within the healthcare space. You've got the big pharma, you've got the biotech, and then you've got some of the distributors, and you've got medical devices and so forth. Some of those areas are doing extremely well, and some aren't doing very well at all. With the Harvest Healthcare ETF, you're paying about 99 basis points management fee to get a covered call strategy where you're getting a covered call overlay and you're getting about a 9 to 10% dividend yield. I see that a lot of investors are really attracted to the dividend yield aspect of some of these investments or some of these covered call strategies. But when you start to compare the covered call strategy against the underlying security, in this case, the healthcare index, a lot of the times you'll see that if you just own the underlying index, you'll do better than owning the covered call. Why? Because a lot of the times when you own the covered call strategies, you're going to get struck out and you're not going to get the upside of some of the stocks in the portfolio. So in this case, it's tends to have a little bit of a better return, at least when I look at a 3-year number against the healthcare index in the U.S. You're getting a little bit of better return just owning the underlying without the income needed there. So it happens a lot with covered call strategies. If you need the income, that's great. Own a covered call strategy. If you don't need the income, then you really should consider just the underlying security with a little bit less management fees and just more exposure to the upside. Covered call strategies tend to do better in either down markets, which why would you own the security anyways, or very volatile markets, which sometimes you get some of these. But in upside markets, which long-term markets go up, the underlying security index will do better.
Got it. Okay, we are going to take a quick break. We'll be back with Stan Wong, Scotia Wealth Management. He's taking your questions today on North American large caps and ETFs. Back in a moment. Welcome back to Market Call. Let's go straight to an email from Galen in Toronto. Galen says, would you be a buyer of PAAS, which is the Pan American Silver on the TSX, at these levels? And at what point would you be a seller? So I had just pulled it up. It's at about 29.14. Does that sound right, Stan?
39.62 is what I have on the TSX.
You're right. I'm on the U.S. Let me have a look.
So these shares bottomed in March of 2024, and it's really been moving very quickly upwards since then. Precious metals have been doing very well. We'll talk a little bit more about silver later on in the show in the top picks segment again. But these shares are up about 45% in the last 12 months. I think that there's upside to silver. Again, I don't want to give away too much in terms of what I want to chat about later on. The acquisition of Yamana is certainly helping them in terms of synergies and integration, optimization, efficiency. So I like the silver sector, but I kind of like owning the silver bullion a little bit more because we can avoid some of the operational and management type of issues that can arise by owning the equities of silver miners.
Got it. Okay, let's go back to the phone line. Then Ray's on the line from Pickering, Ontario, with his question today. Hi, Ray.
Oh, hello. Great day. Hello. Stan, I've been a long-term holder of Berkshire B Shares, and it's been an index beater for many, many years, as you know, and lately it's been going in the opposite direction of the index, and I'm just wondering if you could give me a little background on why that is, and if you would be a buyer at this point with these price of these B shares. Thank you.
Okay, thanks for the question. Let's pull up that chart. I don't think I've met anybody who doesn't like Berkshire.
Sure, yeah. I mean, I think it's been extremely well run, but I think that's the point. Really, these shares started to fall off of its high when Buffett announced that he's stepping down. And since then, the shares have been dropping. It's not really a market-related thing, I don't think. Right now, it's standing at the 200-day moving average, so that's a bit of an inflection point here. I would always characterize Berkshire as a conglomerate of different companies. You have to understand that you own a lot of Apple in this portfolio, less so than a year ago because they did trim their position. So It's a fairly focused and I would say concentrated holding in some names like Apple and American Express and so forth. Then you've got some insurance in the background and so forth. I would characterize this, it's almost like an ETF in some ways, as a bit of a value strategy. So when you've got go-go growth markets and you're going to have, you know, the S&P 500 with 50% in tech and tech-oriented names do a little bit better. And in times of, you know, uncertainty and interest rates moving higher, then you'll see more value type of things do well, like Berkshire and other value type of strategies. So I think I like it long term. I think there's just a big overhang as to the fact that Warren Buffett has decided to step down, and we'll see what happens with the new management, because it's really this company is all based on the management of the company.
Will you worry if it drops below the 200?
I think it's something to watch. I mean, it's not a name in our portfolio, so I'm not going to worry too much if it drops below the 200-day moving average. But I think that for investors need to pay attention if it does. But I think more importantly, like, look at the composition of Berkshire. It's a lot of Apple in there, so I think you kind of tie it to what's your outlook on Apple.
Got it. Okay. Let's move back to the phone lines then. Nazar's on the line today from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Marilla. Hi, Stan. Stan, may I have your thoughts on VDY, Vanguard FTSE Canadian High Yield ETF? I have never held Vanguard product. It has always been BMO ETF products. And if I may, how would you compare it to XEI? Thanks for taking my call.
Okay, so we're pulling up the Vanguard. It is at 51.60 today. What is your take on this Vanguard ETF?
Yeah, so it's a well-run strategy. You're paying about 22 basis points for this strategy. It's a basket of high dividend Canadian-paying names. You're getting around a 5% dividend yield indicated going forward. One thing that I would mention about this specifically is that there's a lot of banks in here. There's about 43% in banks, and then there's another 10% in insurance. So you got to remember you're about 53% in financials in this strategy, which leads to the question about XEI, which is a little less exposure to the financial industry. So it's a bit more diversification in the XEI strategy. We own XEI in the portfolio, but VDY is a great strategy as well. Again, you know, watch out that you do have a lot in banks, so you want to know your exposure to that specific sector.
Are they priced similarly? Is the stock at the same price right now, roughly?
Well, let's take a look.
Just wondering. It depends on how much money he has to put into it, but
yeah, XCI is at 28.40.
and VDY is at about 50, I think we said.
VDY is 51.56 right
okay,
now.
so it depends on how much he wants to put in.
Yeah.
All right, Nazar, hope that helps. As we move on to Jordan from Sylvan Lake. Hi, Jordan.
Hi, thanks for taking my call. Just wanted to get your thoughts on XGD, taking into consideration gold seasonality, and if it's a buy or a wait for a pullback. Thanks.
Okay, thank you for the question. XGD.
Thank you. So this is simply a basket of gold miners in North America, Canada, 45 holdings in total. In this particular ETF, 64% Canada, 20% in the US. So you've got names like Newmont, Wheaton Precious Metals, Barrick, Agnico Eagle Mines. My sense is that, certainly gold has performed extremely well over the past year and a half, 2 years. I think it's a bit of a crowded trade at this point. I think that investors should, if you own it, you should start looking at other spaces within precious metals. And again, we'll talk about it in top picks. But this ETF has done very well. It's up about 58% in the past 12 months. But there's a lot of talk about gold. I know that a lot of speculation that central banks around the world are sort of loading up on gold, which is helping it. But is it too late at this point? Is it getting a bit crowded? And not to say that gold prices can't move higher. I just wonder if there's other areas that we could take advantage of within a similar space. So we can chat about more of that on Top Picks.
Got it. Okay. We are going to take a quick break then. We'll be back with Stan Wong in just a moment. Stay tuned. back. Time to take a look now at past picks from Stan Wong. This was June 6th of 2024, so just over a year ago. Time is flying by. You looked at Amazon last year at 185 American. Now it's at 212.45, so 15% upside for return and total return. Amazon, do you still like moving forward? And is it more because of cloud or retail?
It's because of everything.
Okay.
We like it, and I continue to hold in our portfolios. You're looking at shares trading at 34 times forward earnings with a next year fiscal year onwards. And I say next year because this year is a bit of a transition year for Amazon with a 20% growth rate going forward. So I like that if we sort of look, mid-long term for this name. Technicals are positive. Shares are trading above the 200-day moving average, which itself is trending higher. I see cloud momentum. AWS growth is reaccelerating again. E-commerce strength is strong. There's more automation in that space, which is improving margins. The advertising business, which is extremely high margin. Whenever you go on Amazon, you see the top ads. That's
Sponsored,
advertising.
yes.
That's advertising, so that's very high margin. That's boosting overall profitability. And I think when you look at the Prime membership, it's at 220 million people globally right now. And that's just that itself. We talk about Apple having an ecosystem. Amazon's got an ecosystem with Prime membership. You've got your free shipping, you've got your music, you've got your television or streaming. So I think that itself is a very powerful ecosystem as well.
Yeah, because some charge for each, right, as opposed to giving you that one package
That's right.
altogether. Okay, so Amazon still a hold for you. Your next topic from last June was Constellation Brands on the New York Stock Exchange. At the time, it was 250.11, down to 168.13. So a 33% drop return, 31% total return drop. They make beer and wines. What has happened to the company over the past year?
Yeah, so first off, we're out of this name. We sold out in February earlier this year, noting that there was a negative technical formation forming, which shares started trading below a falling 200-day moving average. Growth has just really gotten very weak. You're looking at a 2-3% growth rate for this name going forward, so another reason why we sold it. The beer segment is really just decelerating. Modelo and Corona are its top beer names. Modelo remains pretty strong, but overall beer growth is pretty weak. And then distribution rights for Modelo and Corona for Constellation is limited to the U.S. market. So what they've done in the U.S., they can't really replicate in other markets around the world, which has really been a hindrance. And I guess we're not drinking enough wine and spirits. Wine and spirits are a bit are down as well. That segment continues to fall. And there could be a trade down risk as well because Constellation has a lot of more premium type of names. So in a potentially weaker macro environment, it could be that consumers are trading down a little bit. And then I have to wonder this, I think it's 35% acquisition of Canopy growth. Canopy, that could be something that's overhanging the stock as well.
That's bringing it down, yeah. Okay, let's go to your last top pick from June of last year, Mastercard on the New York Stock Exchange. At the time, it was 448.68 American. It's moved up to 586.54. So 31% return and total return upside here. Mastercard, Visa just keep moving ahead. Do you like Mastercard over Visa?
No, because we own both names.
Okay.
Alongside of that, I also own American Express in the portfolio. But we continue to like Mastercard. We continue to buy it for our newer clients and deposits and so forth. The consumer in the U.S. remains very resilient. Spending patterns are still moving higher. You see retail sales at all-time highs or near all-time highs today. And you've heard the term a toll booth model, and that allows them to have pricing power. Names like MasterCard and Visa, they have pricing power in terms of their fees and maintaining that high margin environment. Getting into more fintech partnerships and strategic deals with digital wallets and buy now, pay later type of arrangements, that's helping names like MasterCard and Visa with long-term growth. And just, there's a long runway for growth in electronic payments and digital payments. I mean, we only not long ago surpassed more digital payments than cash. There's still a lot of cash transactions out there, and that's what MasterCard and Visa is going to go after in the coming years.
Got it. Okay, so we will leave it there with your past picks. We're going to be back with Stan Wong in a moment. Stay tuned. Welcome back. Thanks for joining us on Market Call. We're going to get to an email from Ash. Says, could I please have your thoughts on Tapestry and the industry it is in? So Tapestry represents a bunch of high-end fashion brands. How is the luxury business doing these days?
It's interesting because when you look at names like Louis Vuitton and so forth, they have not been doing very well whatsoever. But when you look at Tapestry, it's actually been performing decently. It's above the 200-day. The 200-day moving average is moving higher. And I'd probably put Tapestry's kind of in the sort of mid-high luxury, I suppose. Coach is about 75% of its revenues. Kate Spade is about 20%, and Stuart Weitzman is 5% of its revenues. So I think that sort of mid-market, mid-high market is doing much better than some of the other, very high type of areas such as Gucci and Louis Vuitton type of items.
Do you worry about a downturn in the economy? I know people are sort of pulling back on how bad it could be, but is that a concern for a brand like this?
It could be that we're seeing a downshift in type of spending from Louis Vuitton or Gucci into these types of names. Certainly we see that in the stock prices. You're paying 15.5 times forward earnings, which is slightly above 10-year historical norms for this name, for a 9-10% growth rate. So the valuations look decent. However, it's not a name in our portfolio. I try and stay away from some of these more specific type of areas, whether it be apparel or this type of luxury. We did own Louis Vuitton way back when, but right now we don't have any of those luxury names out there. So yes, I would be possibly concerned about a downturn in the economy or softness in the economy for these types of names.
Got it. Okay, let's go back to the phone lines. John's on the line from Brantford with his question. Hi, John.
Hi. I wondered what Stan thought about QQY. It pays a really good dividend, almost 16%. Is this a good long-term holder for just looking for the dividend yield? Thanks.
Okay, thank you for the question. Let's pull up the chart and have a look. Can you tell me about it?
Yeah, so this is simply owning the NASDAQ in Canadian dollars and overlaying a cover call strategy, providing a pretty nice dividend yield in there. With that being said, again, we talked about cover call strategies and how often the underlying securities perform a bit better. So when I take a look at the QQQY against the NASDAQ index over the last 3 years as an example, and all in Canadian dollars, you would have had a bit of a better return when you look at the NASDAQ 100, which is what this is more involved in versus the cover call strategy. Again, if you're looking for income in the portfolio, then it makes sense to collect that income. But when I sort of do some of the numbers against the NASDAQ 100 underlying base index, you would have had a bit of a better performance despite getting this 10% plus dividend yield or distribution yield. Got it.
So if you want the dividend, stay in. Otherwise,
if you need the distribution, then it makes sense to own a cover call strategy. But if you're looking at it and the appeal is just a yield, then you've got to look further and look at how well underlying securities do by itself without the overlay of cover calls.
Got it. Okay. Let's go back to the phone lines. Jason is on the line today from North Bay, Ontario. Hi, Jason.
Hi. Good morning. Afternoon. Yes. First, I'd like to say what a great show and the great guests. My question for Stan is regarding ticker symbol SJM, Smuckers. They've had a recent drop, obviously with some of the base news on Hostess in the past. I'd just like his opinion whether or not with this drop, is this a buy?
Okay, so Smuckers did report. They've been hit hard by tariffs, right? They have Folgers as their brand, and so input costs have risen for them, and they're trying to deal with how to pass those costs on to the consumer and been locked in a bit of a problem trying to do that. Mm-hmm. What do you take on some of these brands that have been hit by tariffs and other things, and so the stock has dropped? Like, would you invest at this point?
I think the packaged food business in general is challenged, not just by tariffs, but just the fact that input costs are rising around the world, aside from that, just due to just normal inflation over the years. When you look at some of these names, they tend not to really fall into our screens just because the growth rate tends to be a little bit weaker. So when I look at JM Smuckers going forward, we're seeing a 3.3% growth rate in earnings forecasted going forward. Yes, the PE seems a bit cheap at 10 times, but the growth rate really prevents me from wanting to own a name like this. You know, one of the advantages is you're getting a nice yield in this name. You're getting a 4.5% yield. I believe that should be fairly safe. But I just think that the earnings growth rate for the way we look at things is really doesn't fall into our radar. When you sort of look at the broader sector, which is consumer staples, we did own Costco. We did own, you know, names like Walmart and so forth. They've been on a power tear. They've been doing very well, but they've gotten expensive as well. So, you know, those names have gotten expensive. I've taken Costco out of client portfolios, and then you look at a name like Smuckers, and you're paying also around 3-4 times PEG ratio. So that's because the earnings growth rate is just weak at this point. So, and then you look at the technicals, that obviously is below the 200-day moving average. That 200-day trend is moving lower. So for me, not something that we own in our portfolios. It seems to be a bit of a value name at this point. But as you know, value names can get worse as time goes by.
Would you hold it if you had the stock?
I think it's rather oversold at this point, so perhaps you might want to wait for an opportunity. Like right now, it's showing a 25 RSI, relative strength index, which indicates an oversold short-term proposal at this point. So I would maybe wait to see if it can rebound a little bit. But I think, you know, beyond 6, 12 months, 18 months, I probably wouldn't. If I held it, I wouldn't own it.
Got it. Okay, let's go back to the phone lines, get in another caller. Peter from Niagara Falls, Ontario. Hi, Peter.
Hi, Stan. How you doing?
How are you?
I was wondering about the Coke stock. I'm wondering if you would buy it right now, or if it's too high, and what you think of it in the near future.
Okay, so CocaCola, would you put this in the same space as what we just talked about, some of these food staples, but necessarily are having a bit of a harder time right now?
They're in a similar space, but I would say that Coca-Cola is a little bit more focused, and it's got quite the branding. But in terms of valuations, I think they're very close to Smuckers and some of those other packaged food type of names. You're paying 24 times forward earnings for a 5-6% earnings growth rate. So again, this wouldn't sort of fall into our radar screen for what we're looking for. The difference between this name and a Smuckers is that technically it's actually doing okay. It's above the 200-day moving average, and the price is above that, and the 200-day moving average seems to be trending slowly higher. But from a growth perspective, I mean, probably not much there for me to own. You're getting about a 2.8% dividend yield, which is okay as well. But just for us, we're looking for a little bit more growth in the portfolio. We're also looking for names that have limited competition, and both this and Smuckers wouldn't fall into those categories.
Got it. All right. We are going to answer more of your phone calls and your emails when we come back. Stay tuned. Welcome back to Market Call. Sal's on the line from Toronto with his question for Stan today. Hi, Sal.
Hi there. Yeah, my question is on Meta. I was wondering if now would be a good time to enter into a position in Meta, given that it's had quite a bit of a run over the last month or so. I'm wondering from a valuation perspective if it's a good buy. Thanks so much.
Okay, so Meta in the big downturn of April went down to sort of 483. It is back up to 692 today. Would you invest in Meta? What do you see with your tech stocks? What do you like?
So Meta's not a name in our portfolio, but I do respect the name. I think it's a name that shows some pretty decent valuation at this point. Technicals look strong as well. You know, we're a step away from breaking the previous all-time highs at 740, so we're not too far from that now. You're paying about 27 times forward earnings for about a 15% growth rate, so that's not a bad PEG ratio there too. A lot of concerns previously about, you know, what they're spending in the metaverse and the capital spending there held back the stock a little bit, but since then it's really been moving forward a bit. But in this space, you know, when you look at the mega cap names, like we own Amazon, I like Amazon, we have Apple in the portfolio, but Meta is not one of those names. We have Nvidia in the portfolio, which we will chat about later as well. But Meta's not in the portfolio, not that I don't like it, I just think that we don't want to overload in the tech space because we've got a decent exposure to technology. We want to have exposure to financials and so forth that I think are going to be one of the leaders moving forward. or industrials for that matter. But I like the name. I think technically it looks okay. Valuation-wise, it looks okay. Just watch out for that overhang of what they're spending in the metaverse. But they're certainly cornering the whole social media space with Facebook, WhatsApp, and so forth, and Instagram, of course.
Got it. Okay, let's move on to Winston calling from Winnipeg with a question today. Hi, Winston.
Hi there. Thanks for taking my call. My question was on Abercrombie Fitch. I heard the CEO speak recently, and it seems with the recent earnings that they're kind of turning around. I was wondering what your thoughts are.
So Abercrombie and Fitch, clothing retailer, long-standing brand, but they have been doing pretty good as you know, some of these brands fall off and people don't want to shop there anymore, but they seem to be doing well. Their stock's down, though, to 78.53.
Yeah, this was a previous high flyer. It was doing very well into the summer of 2024 last year. And, you know, as I mentioned before, when you look at apparel, like consumer tastes and ideas change. Look at Lululemon. That had a pretty rough earnings result a week ago, I think it was. So from a technical perspective, it's difficult to want to own this name for us. Again, the 200-day moving average is falling alongside of this the trend line, and also the prices below that, of course. You know, earnings growth is very murky right now going forward. Certainly the stock long-term is oversold, but we don't really see, you know, according to Bloomberg, not really seeing a lot of earnings growth again until far into the future, like years later. So we see very, very weak earnings growth going forward. In fact, in some cases, almost negative or very, very flat. So not a name that kind of falls into our space. You know, you obviously depend on, you know, how Hollister does and so forth in that sort of segment. But again, previous high flyer, tastes change, consumers change what they like, and you know, their guidance and their numbers going forward look a little bit soft.
Got it. Okay, let's go back to an email now from Mark. Mark would like to know Stan's thoughts on Disney and for a longer-term hold. Disney making some movement as well. Overall, what do you think of the company? And is it a stock that'll continue to grow?
Yeah, I mean, this stock has been very interesting. I mean, you go through periods of time in which the stock is really just very, very challenged, and all of a sudden we see it at near 52-week highs again, as we see it today, and this sort of spike. And really, this is a result of, you know, fears about a slowdown kind of, you know, being put at bay at this point. I would suggest that, you know, because Disney has a few segments, you got to look at those segments and how they're doing. Certainly the theme parks, they're expanding, they're doing quite well, but, you know, it's obviously dependent on the macro environment. You look at the ESPN and those types of things, that segment is obviously a little bit more challenged because we're all streaming right now. And, you know, going to the streaming, they have Disney Plus, and that's been challenged because Netflix is beating everybody at this point. So Disney Plus, I would say, is a, you know, very specific segment in terms of the consumer and where they're targeting. And, you know, content is very expensive. They went from producing a lot of content and then management saying, okay, we're going to reduce the amount of content to save expenditures, but then does that cost you subscribers? I think it's a good platform, but, you know, Netflix has very local content around the world, so they're drawing in subscribers that way. And they've got, you know, just a lot of volume of content as well, so they can beat Disney in that perspective. You're paying 20 times earnings for a 12-13% growth rate. I don't dislike the name. I just think that, you know, there are segments of Disney that are still challenged at this point.
Got it. Okay, we are going to leave it there right now, and we will come back with new picks from Stan in a moment. Welcome back. We have some new top picks from Stan Wong. His first one is iShares Silver Bullion ETF on the TSX. We talked a little bit about silver earlier. You're sort of moving off of gold and into silver. Tell me about the timing.
Yeah, I think, again, gold is getting a little bit of a crowded trade. Not to say that it won't continue to move higher, but I think silver presents a better, compelling opportunity going forward. So this particular ETF, the iShares Silver Bullion ETF, they give investors currency hedged access to physical silver price in Canadian dollars. You can also own SLV in the U.S. if you have U.S. dollars to own silver. So, obviously no FX risk in this one. Silver just topped $35 recently. So that's a technical breakout. It hasn't been there in over a decade. So there is a bit of a technical breakout and a technical positive formation there as well. So it's breaking that long-term resistance. And then when you look at the gold to silver ratio, so gold price to silver is 90 to 1, or they're thereabouts right now. The 50-year average is 60 to 1. So there is a valuation discount for silver at this point. If you look at the 2008 scenario after the financial crisis, that ratio is around 80 to 1, so similar to what it is today. Silver moved up 4 times, quadrupled, after it hit that 80 to 1 ratio. So I think there's a bit of an opportunity there. And of course, when you look at silver compared to gold, there's industrial demand for silver as well in EVs, in solar panels, in advanced electronics, LED screens, and so forth. And mining supply globally is pretty tight for silver as well. You've got the diversification benefit of silver, low correlation with stocks and bonds, which will help lower portfolio risk. There's a bit of a hedge against, uncertain U.S. dollar as well. So I like the setup of silver today, the fact that it's broken above, and the fact that that ratio of gold to silver price is 90 to 1.
Why do you think we don't think of silver the way we think of gold?
I think gold's just the first thing we think of when we start thinking about safe haven and so forth. That's the first place we look, and silver kind of lags. We've seen that in the history before, but then silver can really make a move. So far this year, silver has been very, very neck and neck year to date with gold. It's just a couple percentage points behind gold. So we see that sort of potential overtake of silver over gold if we pay attention to that gold to silver ratio.
Got it. Okay, let's get to your new top pick. The second one is McKesson. They're pharmaceutical distributors, I guess. We talked about healthcare and that healthcare stocks remain sort of flat. Why do you like McKesson?
I like names like McKesson and its competitors, Cardinal Health and Cencora, and Cardinal Health just had great numbers this morning as well. For its reliability of earnings. So they basically, these 3 names control 90% of North America's drug distribution in the pharma space. Revenue in 2026 is expected to top $400 billion for McKesson. You've got steady prescriptions, you've got specialty therapies which increase their margins and so forth. They're in the oncology drug space, so they deliver that. So there's good margins in that space. Some of the automation and AI and data and digital infrastructure improvements is helping margins for this type of name. You're paying, not a bad earnings growth rate to get a 10 to 12% earnings growth rate. So you're paying a decent PE. Right now, today, about just under 70% of Americans take at least 1 prescription drug a day. 25% take 4 or more. And with the population aging and chronic diseases becoming more complex, that's going to support volume growth in terms of prescription drugs, which means better days ahead for a name like McKesson. Technical strength, you got long-term uptrend. You don't find a chart better than this. Channel of ascending channel of upper higher highs and higher lows. So really like this name. I think demographics will push this along. Really reliable earnings as well. Unlike biotech and pharma names, which can have good growth and then their drugs expire and then not so good growth.
Got it. Okay, let's get to your last new topic, which is Nvidia, which is a well-known name to a lot of people. It's come back quite a bit from its April fall. I think it was at 144-ish today, closing in on 145. And you still like it moving forward despite sort of headwinds from Washington on restricting semiconductors and where they go.
Yeah, I mean, I like to look at things medium, long term. So all these things happening with the U.S. and restrictions and so forth, I look at them as short-term obstacles. And clearly the stock is starting to rebound quite nicely. And Nvidia today and for the foreseeable future will be the leader in AI computing, and they're going to dominate that accelerated computing space. There's a very strong global thirst and demand for AI infrastructure. We'll see $200 billion in revenue from Nvidia for fiscal 2026, driven by generative AI, large language, and data centers. I just think that they really have unmatched advantages compared to other names in this space with this proprietary CUDA software and advanced GPUs. As you know, data centers are really driving the growth in Nvidia today. And their recent results, they beat revenue, led by and earnings, they led by data center strength. And I think if you sort of step back, AI adoption is still very, very early. We're in the early stages. So cloud providers, enterprises, governments, they're going to continue to race to build better next generation AI infrastructure. And this is one of the very few names in the mega cap space that is still trading at under 1x PEG ratio. In fact, I'm not sure if there's many out there at all at this point. So I think that earnings growth is not really reflected in the valuation of this stock, which we see EPS at 33% going forward.
Got it. Okay, Nvidia back on the list for tech stocks. Thanks very much, Stan, for coming in.
You.
We'll see you again soon. That does it for us here on Market Call. Thanks for joining us. We'll take a look at the markets as we head to a break. See you tomorrow.